Hi, Peter Rose, founder of Longwood Currency Trading, and today I'd like to address my little spiel here to that 21 to 34-year-old age group that I've kind of addressed in a lot of the blog posts that I've done and sort of implicitly within some of the videos, because as a speculator, I'm obviously approach the markets perhaps more aggressively than a long-term trader would, or somebody who's going to put their money in bonds or index funds or something like that. It isn't so much the aggressiveness and the risk that I want to talk about, but it's an attitude, a presence that I just don't find in the 50-year-old group or above. Now, I don't know what's wrong with me. I'm 70 years old, and I'm still willing to push it all to the center of the table and take a run at it in multiple different disciplines and things. So, yeah, that's probably based on the things that I've done in my life and the understandings of the process of nature around us that I have based on 50-year career in martial arts and karate, bachelor's degree in physics, software engineer for 33 years. All these things are things that require you to go outside of your comfort zone and to do things assuming risk in order to have gain. You know, they don't make boats to stay in the harbor. They make them to go outside the breakwater, to go out into the ocean and to sail. And as a result of that, when you can break loose of that, you have a sense of freedom of yourself. The worst thing you can do is fear. And I think that's our worst enemy. As I've quoted several times, the Walt Kelly 1941 cartoon character Pogo said, "We've seen the enemy and he's us." And that's very true. However, in that 21 to 34 age group, you guys have an experience set that's mature enough to differentiate between when you're going to take a risk, just jumping out in front of out between parked cars to cross in the middle of the road, as opposed to assuming a risk. The assumption of risk is something that we should embrace, not the taking of the risk. It's risk nonetheless. You take a risk in driving in your car when you don't wear your seatbelt. You assume a risk by driving in the car by wearing a seatbelt. The risk is in driving the car and going somewhere, but you gain more risk by taking it, by not looking at the conditions that could cause you harm and mitigating those conditions with whatever actions are at your disposal at that particular time. We know in trading that the only thing that we have any control of is over our risk. We can't control how much money a trade's going to make, but we sure can control how much money we're going to lose. And I think because of my background and how I incorrectly started my trading with a large live account and practicing and learning in a large sim account, and my background as a real estate investor and dealing with large sums of money and moving that sort of stuff around, I kind of have a lack of concern for the smaller amounts. And I'm used to playing for the money and not the pips. I've cautioned so many times in my videos that when you trade, you got to trade for the pips. And I don't care whether you're in that 21 to 34 age group or you're in my age group at 70, you better trade for pips and not dollars, because the dollars bring on the emotion. For the older age group, I think because we've been scarred so much by getting beat up in life, by trying things and getting whipped down and trying things and getting whipped down, that when we finally find something that we don't get beat down at, we settle into that as our career. We're very hesitant to go outside of those boundaries and take any or assume any risk to do something new, to take up a new hobby, or to investigate things that we wouldn't normally do. Or God forbid, take up foreign currency trading. What's the matter with me? But I think you folks that are at that younger age group have such an advantage because those things don't scare you. You haven't been kicked in the teeth enough times in order to say, oh man, I'm just not going to do anything that gets me kicked in the teeth. The reason you get kicked in the teeth is because you're taking risks instead of having the maturity that the older folks have in understanding how to assume a risk. So if I can teach you the difference between the assumption of risk and taking a risk, then your appreciation of the fact that you do have control over how badly you'll get hurt in the currency market by simply getting out at a certain pip amount. You know, I was watching a video today from Greg Sucker, and he was very detailed about how you trade. Don't risk more than 2% of your account. And when you lose, only risk 2% of that amount. And it's a very structured and valid methodology of trading, except it violates one of my premier conditions in trading, is that it complicates your mental connection with the chart. Because then you're not trading by dollars, you're trading by, you're not trading by pips, you're trading based on dollar risk. And I think that gets in the way. Professional poker players don't play with cash, they play with chips. They're not trading a car on a bet, they're trading, 3 orange chips. Yeah, it's a difference in the way that you think. So if you're in that age group and you're looking at getting involved in currency trading, you absolutely, positively can't do it the way most of the folks out there who are teaching, writing books or videos or blogs or whatever, are approaching it. Because most of those folks have gone through all the angst and all the stuff that you're trying to go through. They've figured out that trading isn't difficult, that it is simple, but they then go on and complicate it with all these rules about compounding, about 2% of your bank, and all this other stuff in order to preserve their capital and not lose it. When you're young, look, you can afford to take some losses so that you get hurt. You need to get hurt in order to learn. Jesse Livermore said that, the greatest speculator that there ever was. The only way to get a good education in trading is to invest cash, track your results, and learn from your mistakes. Those are the 3 principles of trading that everybody should be doing. The older folks are trying to preserve their capital. The younger folks are trying to make capital. And that's fine for an older person who's successful in trading. Look, if I have a $300,000 or $400,000 account that I'm trading, it's very easy for me to say I'm only going to take a 0.25% risk on my bank. They're not trading with $300,000. They have $300,000 in the account, but they're probably trading with $100,000 of that or whatever. So things need to be balanced correctly for the person who's doing the trading and the position in your trading bank size that you're dealing with, and your age. Unless you're crazy like me at 70, and I made a $40,000. I took a $40,000 hit against my account, and I learned. I learned a lot. $40,000 was a manageable loss for me, but it was an inordinately large amount of money and a tremendously unnecessary way of learning. I learned, but then when I went back and tried to trade the smaller accounts, which I'm in now until I sell my last building, and I could refund it with the money that I have now, but Jesus, I'm retired, so I need to be cognizant of just, I spent $8,000 to put a generator in a couple of months ago, so I can't be digging into that money to repopulate a trading account. I need that cash available for day-to-day living, and one of the things you don't do in your trading account is take money out when you're trading. So, you have to balance where you're at in relationship to how you trade. And that comes down to what many people say is your personality has a tremendous amount to do with how you trade. So in that 21 to 34 year age bracket, you've got all the desire, you got the time to study, and you're willing to take some losses in order to learn, as long as you feel comfortable knowing that you're being taught principles that will allow you to learn from the mistake and not do that mistake again. And there are certain ways that you can learn how to do that. But I think it's going to be difficult for you to learn from books and videos and things like that unless you are taught by a mentor on how to read between the lines of all this stuff. Look, I have transferred out of real estate, and I'm going to make my income from this point on through my currency trading, and there are many reasons I've done that, and I've gone through that in other videos and blog posts at longwoodcurrencytrading.com that I've made that go over the struggles that I've had and the errors that I've encountered in trying to learn how to manage that risk so that it's true assumption of risk and not the taking of risk. I don't think I went too overboard in taking the risks, other than when I let trades run too long. For example, the one that I've been in for the last couple of months, where I just let that run. And it was too small of an account to hurt, as I've mentioned before, from a dollar standpoint. So it was the margin call out that put a stake through my heart and my ego, and I go, man, I'm not gonna do that again. But I will. And the reason that I will is because until I get into a larger account, it's very difficult for me, because I started out incorrectly, in order to take a $1,000 mini account seriously. I mean, what are you going to do? You lose 30 pips, and you're supposed to get wound around the axle on that. It's $30. I mean, like I've said before, that's a pizza. I can't get wound up about a pizza. So it's very difficult for me. I understand what I need to do, and I will be able to apply that when I get to my pain point of loss. It's very important for you to understand what is your pain point. I mean, the fact that you're 31 to 24 age group doesn't mean you could necessarily go in and take $20,000 or $30,000, make 8 or 10% a year or 50% a year on that money, and everything is going to be okay because you're just throwing it up in there. I mean, that's not what I'm saying. What I'm saying is that you need to hone your craft in a simulated account with $1,000. And then when you break out of that and you go to fund your first live account, fund it with $1,000. You may have to reload that account a couple of times. I mean, I can't imagine if you're trading one mini lot that you're going to go through $500, like if you're in the United States. That's three. Right now, with some of the currency pairs, for example, it requires $700 of margin. So of that 1,000, 700's gone just in margin. That's just to sit at the table. So that leaves you $300 to play. But on a mini account with $1 a point, you'd have to lose 300 pips to have to reload that account. I mean, if you absolutely positively didn't know what you were doing, you put a few trades on, over-leveraged, and then walked away from the screen for 2 weeks. I mean, I don't see how you could lose 300 pips on a mini without waking up and going, well, this is really stupid. Maybe I should learn what to do. So it's a cheap way for you, when you get into the real account, to learn. You've learned the mechanics and the plumbing in the simulated account. Start applying that into the real account. And as soon as you start thinking, well, it's only a pizza, man, then you know that you're screwing up. And if you're a student of mine and you pull that shit, I would pinch your little head off. Well, remember, I had the ability to do that with 50 years in karate. So don't fuck with me. And that's why I don't teach people, because they don't want to work that hard. They don't want to discipline themselves that hard. So if you don't want to train with me, listen to what I'm telling you, because it's the real deal. I'm not one of these guys that was an 18-year-old FOREX trader that got lucky and was trading with 200 to 1 leverage and took his $3,000 account to 60,000 and then doubled the 60 to 120, and now he's trading with a $300,000 account. That isn't the way that in real investments work, boys and girls. That's 100% luck, and don't kid yourself on that. And once you get to that $300,000 or $400,000 trading account size, if you've made that much money, you're not trading the way that you were before. You're not trading 100 to 1 with your $300,000 account size, because you know exactly what's going to happen to that money. It's going to go like shit through a goose. Gone. Pay attention. If you're in the 21 to 34-year-old age group, you've got the whale by the tail. All you got to do is learn the mechanics, and that's easy. I mean, my dog could learn the mechanics of currency trading. Couldn't you, Bo? Here's my dog. Here's my dog, Bo. Here's Bo. Hi, Bo. He's looking at me like, who the hell are you talking to me like that? So let me get that stabilized. I hope I'm in frame with this. I'm out on the screen porch. It's supposed to be a real field day today of 98 degrees in New England, for gosh sakes. And it's middle of July, or just creeping on to the middle of July. So we're out here on the screen porch enjoying the day. But look, if you're in that 21 to 34-year-old age group, you can learn the mechanics and the plumbing of Forex trading. If my dog could learn it, you can learn it. That's not the problem. The problem is developing skills under certain conditions that are directly mappable into the live world, where you will lose. You will lose. You may lose right off the bat because you're stupid and don't know what you're doing. You may run into a set of 10 losses in a row. Well, if you've got a 10 pip stop, that's 100 pips you've lost, $100 out of your trading account. You know, you could do that in a day. You could do that in 2 days. But what is it? What's the $100? You're not trading for the $100 because it doesn't mean anything. If you traded that account and made 100% in a year on that account, is that extra $1,000? Is that going to change your lifestyle? It isn't. It isn't. And even if you're poor, that isn't going to change your lifestyle. So why fucking trade for dollars? Trade for the skill and learn how to trade by pips. Learn how to assume the risk instead of being dumb and taking risk like 90% of the other traders. That's why they're failing. It isn't that they don't know how to trade, it's that they don't know how to take and manage their risk. So if you can learn how to manage your risk on that $1,000 account, and you can come out of that on the other side after a year or after 6 months, up 40% in 6 months, or even after a year, 40%, where the hell are you going to get 40% on your money in a year? You're not going to get it anywhere. Unless you are an auto mechanic and you can flip a car about every 3 weeks or something like that. Like sometimes my son does that, and he makes pretty good money on small investments. But if you don't have the skill of being an auto mechanic, what do you want to do? My son went to school for 2 years to learn how to do that. Did you want to take 2 years to learn how to trade currencies? You don't have to. You can learn how to trade the plumbing and the mechanics of currency trading in a couple of weeks. The turtle traders, Richard Dennis's group, the turtle traders, the first group that went through, only got 2 weeks of training, and then boom, they were in trading live accounts. The second group of turtle traders only got 1 week of training. I mean, this shit is not difficult. We only make it difficult because our emotions get involved. Our emotions get involved when we trade for dollars instead of with pips. Listen, if you're 21 to 34, take a serious look at this thing and take a serious, based on what I'm telling you about the differential between your emotional makeup, your psychological makeup in this age group, and your experience in this age group with those when they get to 50. Look at the people around you that are 50 years old. Is that how you want to come out? the average, I think, savings net worth of the 55 to 64-year-old age group is $103,000. How do you retire on Social Security of $1,300 and $100,000 in savings that you can only take 3% a year out in order for that to last? $300. So you get a $1,600 or $1,800 income. How does that work out for you when you're 60? You can't even have an apartment in most places, let alone all the rest of the stuff. Guys, if you're in that 21 to 34-year-old age group, treat this thing like a fucking stop sign. You stop at the stop sign so that you don't get killed. Currency trading could be your way out. It isn't going to be real estate. If you want to know all about why I don't recommend real estate, then get a hold of me and I will tell you why I don't think getting involved in real estate, even 10 years from now, is going to be viable. That market is so difficult and so complex, and you're dependent upon your tenants paying you money. You're dependent on, just so many things. In the currency market, you know who you're dependent on and what you're dependent on? You're dependent on you. That's all you've got. You don't have to go to work for a job. You don't have some asshole telling you to hit your numbers or hit the door. This is it, guys. If you do it right, you can make money. But if you're going to do it the way a lot of these people are trying to tell you that you can do it, and you drive it around in your Lamborghinis and staying in Costa Rica and spending all kinds of money floating around in the world, if that's your vision of how things are going to work out, wake up. You got to start right. You got to build a trading plan. You've got to learn the difference between taking a risk and assuming a risk. And then you've got to methodically work your way through until you're successful with that small account. Because if you can be successful with that small account, then you've truly traded for pips and not for the dollars. So that means that you're able to control your emotional structure, your worst enemy being you. You can then take that skill, and however you can figure out to do it, build yourself up $20,000 or eventually work your way up into a $100,000 account. And then you don't have to work for anybody else, because the money that's thrown off from a $100,000 trading account in currencies that's the yearly income. You can live on that. And you can take that money when you're 50 years old, and you can take that account and say, well, look, I know I'm only going to get minimum Social Security, but I've got this money coming in, which if you thought you were going to be able to live on Social Security and you're able to make Social Security or more money on your trading account, now you've got 2 times that. You may be close to being able to just retire at that point. But if you really hone your skills, I mean, we're not supposed to say how much money you can make or what kind of percentage return. People on the thing all the time, they're saying, oh, I made $10,000 today. Well, yeah, but what was your trade size account? $400,000? What was your leverage? Were you trading 200 to 1 on a $20,000 account? Yeah, you could probably make $10,000 a day or $6,000 a day on that. Look reasonably at what the future, guys, is going to hold for you. You know, the United States and Great Britain and Canada, they don't allow 100 to 1 leverage or 200 to 1 leverage anymore. The rules changed. You go to Cyprus or somewhere and you can get an account, well, they'll still let you trade for 200 or 500 to 1 leverage. But try to get your money out when it's time to cash out. You know, they can change the rules in the Forex market, just like they can change the rules in the stock market. They can change the rules. So don't learn based on the fact that you could get 100 or 200 to 1 leverage today, because that isn't going to hold up. If you're in the United States, that isn't going to work for you. So learn the skill under the rules that are trading rules and not situational rules, so that when you're 50 years old, you have a large amount of money and you can trade that money, and then you can go off into protection mode. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.